We're analyzing AstraZeneca, stock ticker AZN, to see if this is a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for AstraZeneca. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing AstraZeneca for your stock portfolio. Before we get into these valuable metrics, let's understand AstraZeneca's stock performance. Right now, AstraZeneca trades for $69.34 per share. Year to date, their stock price is exactly flat. Right now, AstraZeneca pays an above average 2.05% dividend yield. That's added on to the returns from their stock price. In the last 5 years, AstraZeneca compounds at 12.5% annually. In the last 10 years, they're compounding at 10.5% annually. Going back before the global financial crisis, AstraZeneca has compounded at about 7% annually in the last 2 decades. Keep in mind their average dividend yield is added to these returns. AstraZeneca trades $7 below their 52-week high. The company is up nearly $16 from their 52-week low. AstraZeneca's a huge business. They have a $214.5 billion market cap. But the burning question is, why should we be paying close attention to AstraZeneca? A merger between Astra of Sweden and Zeneca Group of the United Kingdom formed AstraZeneca in 1999. The firm sells branded drugs across several major therapeutic classes, including gastrointestinal, diabetes, cardiovascular, respiratory, cancer, immunology, and rare diseases. The majority of sales come from international markets, with the United States representing close to 1/3 of its sales. Just recently, in January of 2023, AstraZeneca announced it's acquiring Syncor Pharma for $1.8 billion. They also announced an acquisition of Teneo2 for $1.3 billion in July of 2022. Similar to other pharmaceutical business, AstraZeneca has grown a lot through mergers and acquisitions. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want AstraZeneca's average 5-year return on capital to be above 14%. The average business earns about a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. In this time, AstraZeneca's returns on capital have increased. They earned just under 13% returns in their last fiscal year. When these are averaged out, AstraZeneca earns 8.5% returns in an average year. These are just a little bit above average, but they're below the benchmark we're looking for. This is an X on metric number 1 for AstraZeneca. Metric number 2, we're looking for growth in their revenues, net incomes, and free cash flows. We want to see this growth across the board in their last 5 years and up until today. All 3 need to be up for this to be a check. In this time, AstraZeneca's almost doubled their revenues, their earnings are up 2.5 times, and their free cash flows have grown by 5.5 times. This is huge growth for AstraZeneca, a big check on metric number 2. Metric number 3, we're looking at AstraZeneca from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. The company's earnings have grown by 2.5 times in the last 5 years. They've also diluted shareholders by 23%. It's been pretty steady dilution through most of these years, mainly for a series of smaller acquisitions. Despite their dilution, they've grown their earnings faster than this, meaning AstraZeneca's grown their earnings per share. This is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. A similar situation here. AstraZeneca's free cash flow growth outpaces their shareholder dilution. This is a check on metric number 4. To recap where we stand currently, AstraZeneca has 3 checks and only 1 X through 4 metrics. During recessions, it's overly levered businesses that can have the biggest losses. Metric number 5, we want AstraZeneca's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in the last 5 fiscal years. AstraZeneca's added on to their net debt through their acquisitions over this time. The company ended last year with about $25 billion in net debt. Right now they have $26 billion of net debt. In this last 5-year time frame, AstraZeneca's generated $21 billion worth of free cash flow. Keep in mind, since making some of these acquisitions, and especially since 2020, the company's free cash flows are up pretty big. Because of their high growth, this could unfairly penalize the business if their current levels are sustainable into the future. AstraZeneca's only produced $21 billion of free cash flow in their last 5 fiscal years. This comes in below their net debt position, meaning this is an X on metric number 5. They produced $8.6 billion of free cash flow in their last 12 months. They could pay off their entire net debt position with just over 3 years worth of free cash flow. So they are cash flow generative compared to their net debt right now. It just doesn't look that great on a historical basis. Before we get into the first of 2 different ways we're estimating a value for AstraZeneca, you won't want to miss our bonus. As our bonus, we're looking at AstraZeneca's dividend profile. Right now, AstraZeneca pays an above average 2.05% dividend yield. People make mistakes by blindly chasing dividends. We want AstraZeneca to support their dividends using their free cash flows. That's been the case in 3 of these 5 years. They've grown their dividends per share since 2020, and since 2021, they've supported their free cash flows per share. In some of these previous years, they've had very high dividend payout ratios, even when they've supported their dividend. In their last fiscal year, their dividend payout ratio was more appropriate. Right now, it looks like AstraZeneca supports their dividends, which is what we're looking for. This is the check on our bonus. Keep in mind, this is a snapshot of their last 5 years of performance, and it's no guarantee for the future. We would have rather seen AstraZeneca support their dividends in all 5 years. However, that's not the case. The big metric of them all, metric number 6, we want AstraZeneca's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for AstraZeneca. Right now, AstraZeneca has a $241.5 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at AstraZeneca similar to it being a private company. In the last 5 years, we learned AstraZeneca's generated $21 billion of free cash flow, meaning they generate $4.2 billion worth in an average year. When that's divided by their enterprise value, it gives us around a 1.8% average free cash flow to enterprise value yield. On a current basis, AstraZeneca produced $8.6 billion of free cash flow in their last 12 months. When that's divided by their $241.5 billion enterprise value, it gives us around a 3.5% current free cash flow to enterprise value yield. Both of those are coming in below the risk premium we're looking for. They're below the yield of the 10-year treasury as well, meaning on metric number 6, this is an X for AstraZeneca. Don't just throw the business out. We still need to estimate their fair value per share and give our final rating. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze AstraZeneca, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. AstraZeneca's had a low degree of business predictability in their past, due in large part to their history of acquisitions. This impacts our assumptions. We're starting with an average of their last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for AstraZeneca. Assuming they grow their average 3-year free cash flows at a rate of 5% annually for the next 10 years, then in the following decade, assuming that this growth rate is 4% annually, we won't be adding in their tangible book value, as that's likely skewed due to their history of acquisitions and how the company has issued shares. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, at today's valuations, an estimate of AstraZeneca's fair value per share is only around $13. Keep in mind, because of their low business predictability, our assumptions could be off here. Pharmaceutical companies can be asset-light businesses, and with the accounting treatment for their tangible book value, this could be skewing things for AstraZeneca. This discount rate is an estimate of total returns to shareholders based on their free cash flows. It includes both their dividend yield and their stock price gains. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to AstraZeneca, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for this company. What are they? Starting with the factors supporting a long thesis, number 1, AstraZeneca has a large presence in emerging markets and can benefit from these markets' fast growth prospects. Number 2, the management team is focusing the pipeline toward unmet medical need, which should increase the odds of success and bring strong pricing power for new drugs. Number 3, the company is expanding its oncology presence with several important pipeline products. In particular, the company's EGFR drug, Tagrisso, holds major blockbuster potential in lung cancer. but we'd be remiss if we didn't cover the negatives of the business as well. Looking at the factors supporting a short thesis, number 1, emerging EGFR drugs could pose a major threat to AstraZeneca's high-selling drug Tagrisso if the new drugs are priced lower or have better clinical data. Number 2, Astra holds some litigation risk with several historical drugs focused in chronic care areas that may eventually spark legal concerns around long-term side effects. Number 3, the company's strong entrenchment in respiratory disease could cause challenges, as pricing power in this market tends to be weak. There you have it for a balanced perspective of some of the qualitative factors for AstraZeneca. Now it's time to give our rating. In analyzing AstraZeneca, stock ticker AZN, we learned this pharmaceutical company has grown by a lot on the back of a lot of acquisitions. They're narrowing the focus of their drug pipeline, which is currently spread across a number of therapeutic areas. With their broad scope and their focus on emerging markets, the company earns just above average returns on capital, below our benchmark. Even though they've diluted shareholders, they've still grown on a per-share basis. Historically, AstraZeneca's free cash flows don't support their current net debt position, but those are supported currently. AstraZeneca's also currently supporting their dividends, while historically that has not always been the case. They've been growing their dividends in the last couple of fiscal years. It's worth reiterating this analysis is not financial advice. AstraZeneca's free cash flow to enterprise value yields don't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, if today's valuation multiples are the same 20 years into the future, you believe those assumptions and you want a 15% rate of return, an estimate of AstraZeneca's fair value per share is only around $13. Remember, this is not a buy or sell recommendation of any security. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about AstraZeneca, and let me know what business to look at next in the comments below. Thanks for learning about AstraZeneca with me, and have a great day.